Hello everyone. Now let's continue our discussion about inventory, and we're going to focus more on the inventory costing methods, which are FIFO, LIFO, and weighted average, but we're going to implement them under two different systems, the perpetual inventory system and the periodic inventory system. So we'll start with the perpetual inventory system. So for purpose of illustration, let's see the following example. We have this item that's called 127B, which is one of the items in our company's warehouse that's considered to be part of our inventory. It has a beginning inventory balance of 1,000 units that originally costed us $20. Then on January 4th, we sold 700 units out of the 1,000 at $30 each. That's the selling price. Of course, in this case, the cost of all the items sold is 20 because we only have one batch of inventory. Then on the 10th, we purchased 500 units. So now, if you think about it, the 1,000 units went down to 700 went down to 300. And now we added 500, so now we have 800 units available. But the problem is 300 units are at $20 and 500 units at $22.40. So you can see we have like two batches now. A batch for 20 and another batch for $22.40. So on the 22nd, we sold 360 units at $30 each. So the question is, which value should we use? Should we use the 20 or the 22.4? And this would depend on the approach we're using, whether it's FIFO, LIFO, or weighted average. On the 28th, we sold another 240 units. And then in the last day, or actually close to the end of the month, on January 30th, we purchased 600 units at $23.30. So you can see that the cost keeps increasing, which is very normal in reality. So when the FIFO method is used, costs are included in the cost of goods sold in the order in which they were purchased. This is often the same as the physical flow of the goods. Therefore, the FIFO method often provides results that are about the same as those that would have been obtained using the specific identification method. Yet, it's not always the case, but it's somehow similar. So let's see here. In order to solve this problem, or try to calculate the cost of goods sold in the ending inventory, which is our ultimate goal here, the best approach is to create this kind of table, where we have a column for date, a big column for purchases, big column for cost of goods sold, and big column for inventory balance. And then for the purchases, we're going to divide it into quantity, unit cost, and total cost, and same thing for cost of goods sold and inventory. And then we start with January 1st, where we record our initial 1,000 units at $20 for a total cost of $20,000. On January 4th, remember, we sold 700 units, so the cost of these were 20. Remember, we sold them for $30, but now we're just focusing on the cost. So we are going to record the cost here of 20 because we only have a batch of 1,000, and the remaining is 300 units. So 300 units at 20 for $6,000. On January 10th, we purchased 500 units, but the cost was slightly higher, $22.40 for a total of $11,200. So if you multiply 500 by the 2240, you get the 11,200. Now our inventory balance consists of two batches, and this is why we have like a bigger line or raw here. So we have 300, which is these 300 units that were part of the 1,000 that we started with at $20, and the 500 that we just purchased. So 300 at $20, that's 6,000, and 500 we just purchased at 22.40 cents, that's 11,200. Now we sold 360 units. And remember, we're applying now first in, first out. So if we are applying FIFO and we are under the perpetual inventory system, on the 22nd we have to decide how we're going to recalculate the cost for these items. So that we just sold, which was 360. So we start from the beginning, okay? The cost of goods sold, we sold the first in or the first out. So we have 300 units at 20. So we're going to use these. And then we still have 60 units that we sold. So we take out of the 500, 60. So 60 at 22.40. And that would leave us for an inventory balance of 440. So if you do the math here, 300 multiplied by 20, that's 6,000. And 60 multiplied by 22, 40 cents, that's 1344. Add them together, that's 7,344. And the remaining balance is 440 at 2240. That's equal to 98.56. On the 28th, we sold another 240 units out of the 440. It's only one batch now, right? So we take the 240 multiplied by 22.40 cents, and that's 53.76. And when we take 240 out of the 440, the 200 only are left now. So 200 multiplied by 22.40 cents, that's 44.80. And then on the 30th, we purchased another 600 units at 23.30 for a total of 13,980, and we got this 13,980 by multiplying these two values together. And now we have two batches, a batch of 200 at 22.40 and the 600 at 23.30. So multiply each one of them is 44.80 and 13,980. So to calculate the cost of goods sold for the month for this item, we just need to add the total of the total cost. So we take the 14,000, 6,000, 1344, 5376, and that would be 26,720. And to calculate the ending inventory balance, we just look at the last inventory balance here, which is 4480 plus the 13,980, which is 18,460. But we'll keep in mind that these are consisting of two batches. But for the balance sheet presentation, we're going to present it as inventory at 18,460. But when we do this for the next month, we have to remember that we have two batches within these items. One for 200 and the other for 600 at two different costs. So, when the ending balance on January 31st is 18,460, the balance is made up of the two layers of inventory as follows, and as I just explained. Now let's see LIFO. So when the LIFO method is used, the cost of the unit sold is the cost of the most recent purchases. The LIFO method was originally used in those rare cases where the units sold were taken from the most recent purchased units. For tax purposes, LIFO is now widely used even when it does not represent the physical flow of units. So the IRS allows you to use LIFO, even if LIFO is not the real thing that you're doing. So when LIFO method is used, the subsidiary inventory ledger is sometimes maintained in units only. The units are converted to dollars when the financials or when the financial statements are prepared at the end of the period. So let's see the same example, but we are going to apply the LIFO approach. So again, the beginning balance is the same, 1,020 for a total of 20,000, and we purchased, we sold 720. And again, whether it's FIFO or LIFO, it doesn't matter because we only have one batch. So the remaining balance is 300 at 20. Then we purchased 500 at 22.40. So now we have two batches starting January 10th, 300 and 500. So the 20 and the 22.40. And this is the total value of our inventory balance. And then on the 22nd, we sold 360 units. So since we're using last in, first out, we're going to start from the bottom, from the 500, not the 300. In the previous case, we started from the 300. In this case, we're going to start from the last batch. Last in, first out. So we take the 500 units, but this is more than we need. So we only take the 360 multiplied by 22.40. So the remaining balance, we still have the original 300 that we started at $20. And out of the 500, we deducted 360, so that's remaining 140. So 300 at 20 and 140 at 22.40, and that's our total cost inventory balance on the 22nd. On the 28th, we sold another 240 units. Again, remember, last in, first out. Our balance now is 300 and 140, but we have to start from the bottom. The 140 is not enough, so we take 140, the entire 140 at 22.40, and then out of the 300, we take 100, and that would leave us with 200 remaining balance from the original cost, which is 20. So 140 at 22.40 and 100 at 20, that's our cost of goods sold. And our inventory would be 220 for a total of 4,000. Then on the 30th, we purchased 600 units at 23.30 for a total of 13,980. So now we have two batches, the original 200 at 20 and 600 at 23.30. So these are the total cost. So to calculate the cost of goods sold, we add up all this column, 27,200. To calculate the inventory, we just calculate the total in the last transaction, which is the 4,000 and the 13,980. One trick you'll notice, the total of cost of goods sold and the ending inventory in LIFO or FIFO is always the same. So here it was 18,460 and 26,720. Use your calculator and get their total. You'll find that they're exactly the same as the total here is 27,200 and 17,980. On the left here we have the journal entries, and the journal entries are very traditional. So of course for the beginning balance we don't have a journal entry. For the fourth, when we sold items, remember we have two journal entries. One to record the sales based on the $30 selling price. So we sold 700 at $30 each. So we debit accounts receivable and we credit sales at 21,000. And then the cost of goods sold is the 14,000 as calculated here. So we debit cost of goods sold and credit inventory. When we purchased new items, we debit inventory and we credit accounts payable for the 11,200. And then the same thing for the sales transaction, we have two journal entries, one based on the selling price, which is $30, and the other one based on the cost of goods sold, which is what we have here, the 8,064. Another one for another sales transaction, 7,200, which is the 240 multiplied by $30, and the journal entry, the second journal entry is for this value here, the 3136 plus the 2,000, which is 5136, and where we debit cost of goods sold and credit inventory. And then the last purchase transaction, we debit inventory and credit accounts payable. You can see here, it's very systematic. It's not much different from what we covered in chapter 5. So the ending balance on January 31st is 17,980. The balance is made up of the two layers of inventory, which is the beginning balance, beginning inventory of 200 at the $20, and the last 600 units that we purchased at 2330 for a total of 13,980. We add them together, that's 17,980. Now let's see under the perpetual inventory system the weighted average cost method. So when the weighted average cost method is used in a perpetual inventory system, the weighted average unit cost for each item is computed each time we have a purchase transaction. So this unit cost is used to determine the cost of each sale until another purchase is made and a new average is computed. And that's why we call it sometimes a moving average, because it keeps changing with every purchase transaction. So let's see here. We started with our beginning balance, 1,000 units at $20. We purchased, actually I'm sorry, we sold 700 units, so the average in this case is 20 units, it's $20 for a total of 14,000, and the leftover now is 300 at 20 for 6,000. Now we purchased 500 at 2240 for a total of 11,200. So what we're going to do is that we take the 11,200, we add to it the 6,000, so that's 17,200. That's the total cost. And how many units do we have now? 300 and 500. This is 800. So we take the 17,200 divided by 800, and that's our new weighted average, 2150. So that's the average that we're going to use. We don't have layers anymore. We just put them together in one batch, and we just calculate a new average. How did we calculate the average? We calculate the total cost, we calculate the total units available, divide the cost by the units to get the weighted average unit cost per unit. Then we sold 360 and 240. So the 360 at the 2150 and the 240 at 2150. You see here these are two separate transactions, and they reduce our balance from 800 to 440 to 200. And then in the last transaction we purchased 600 units at 2330 for a total of 13,980. We do the same thing. Take the 13,980 plus the 4,300. That will give us a total of 18,280. And now we have 200 units plus 600 units. That is a total of 800 units. Take the 18,280 divided by 800, and that would be 2285. So now after this new purchase transaction, we updated our unit cost to be 2285. And how did we do it again? By getting the 18,280, which is the total cost for all the items we have on that specific date, divided by the number of units we have at that specific date, which is the 200 plus the 600. And when we divide these numbers together, we get 2285. So now our ending balance consists of 18,280 for 800 units. And the total cost or cost of goods sold for the period is this column, which is 14 plus 7740 plus 5160. So I hope this makes sense. Now let's briefly go over the periodic system. So when the periodic system is used, only revenues is recorded each time a sale is made. No entry is made at the time of the sale to record the cost of goods sold. So this is one thing that we didn't discuss that much in chapter 5 because it's an appendix. I don't really focus too much about the journal entries for that. So just to let you know, the cost of goods sold under the periodic system, it's done only once in a year. So at the end of the accounting period, a physical inventory is taken to determine the cost of the inventory and the cost of goods sold. So similar to the perpetual inventory system, a cost flow assumption must be made when identical units are acquired at different unit costs during the period. So in such cases, the LIFO FIFO weighted average cost method is used. So let's see an example. So assume we're using the FIFO method in a periodic inventory system. We use the same data for the items 127B as in the perpetual inventory system. The beginning inventory was as follows. We had on January 1st 1,000 units. On the 10th we purchased 500 units. On the 30th we purchased another 600 units. And this is what's available for the month. If you add these three numbers, that's 2,100. So physical count on January 31st shows that 800 units are on hand. So at the very end of the period, we found that 800 units are in hand. So remember, we had a beginning inventory and purchases of 2,100. And at the end of the month, we were only left with 800. So how many units did we sell? That's the difference. So 2,100 minus 800, that should be 1,300 units been sold. Okay? So using the FIFO method, the cost of goods sold in hand at the end of the period is made up of the most recent cost. The cost of the 800 units in the ending inventory on January 31st is determined as follows. So we're thinking now using FIFO, first in, first out. So the cost of the items that is still left in our ending inventory would be the most recent items, which are the 600 units that we just purchased in the very end at 23.30. And we're going to take 200 units at the 22.40. And that's what we've done here. 600 units at 23.30 and 200 units at 22.40 for a total of 800, and that would be the total cost. And by the way, this value will, let me go back here to the FIFO method, would be exactly the same under the perpetual system. Okay? So, deducting the cost of the January or the ending inventory, 18,460, from the cost of goods available for sale, which is the 45,180, would give us the cost of goods sold. Another approach to do this, instead of focusing on the ending inventory, you could have also focused on the sales or the cost of goods sold. So you could have taken the 1,000 units at 20 and 300 units at 22.40. And that would give you the exact same number that we have here, which is the 26,720. So what they did here is that they started with the beginning inventory, they added the purchases, they got the cost of goods available for sale, and then they deducted the ending inventory, which we just calculated here, to get the cost of goods sold. So this presentation here just shows you the difference between like how the flow would work when you see the purchases. So we had 1,000 units that we started with, we purchased 500 and we purchased another 600. The goods available for sale is 45,180, and then the units sold, which are the 1,000 plus the 300, okay, which is from this batch, and then the remaining 200 from this batch, and the remaining 600, that's our ending inventory. Now let's see how this would work under LIFO. Same idea. When the LIFO method is used, the cost of goods on hand at the end of the period is made up of the earliest cost. So based on the same data for the item 127 as in the FIFO example, the cost of the 800 units in ending inventory on January 31st is 1,600 units, $16,000, which consists of 800 units from the beginning inventory at a cost of $20 each. So the beginning inventory was 20. The purchases, as we can see, 25,180. So the cost of goods available for sale is 45,180. The ending inventory is now 16,000. Again, why did we do that? Because we are using the 800 units based on the $20. So remember, in last in, first out, the inventory is always the original units that we have. The ending inventory is usually the original units that we have. And in this case, we used 800 units from the 1,000 units that we originally had. So to calculate the cost of goods sold, it's 29,180. So we subtracted the ending inventory from the available for sale, or the cost of goods available for sale, to get the cost of goods sold. One thing you notice that the cost of goods sold under LIFO, under the periodic system, let's see, compared here to the cost of goods sold under the perpetual system, they're not the same. Here it was 27,200, and under the periodic system, it's actually 29,180. So they're not the same. And again, the same approach here. We have the 1,000, 500, and the 600. We sold 800 at 20, and then 200 units. Actually, this is the ending inventory, the 800 at 20. And then what we sold is 600, 500, and then 200 from the original units. So we have like 3 batches that we calculated our cost of goods sold from. This is the most recent purchase, 600 units, and then 500 from the previous batch, and then 200 from the original batch. For the weighted average cost method uses the weighted average unit cost for determining the cost of goods sold in the ending inventory. In this case, we don't call it a moving average because it's one average for the entire period. So if purchases are relatively uniform during a period, the weighted average cost method provides results that are similar to the physical flow of goods. The weighted average unit cost is determined as follows. We get the total cost of units available for sale divided by units available for sale. And in this case, the total cost of units available for sale were 45,180 divided by the 2,100 units that we have, and that would lead us to a rounded value of 21.51 cents. So the cost of the January ending inventory would be the 800 units multiplied by 21.51, and that's 17.28. And of course, the value for the cost of goods sold would be the 1,300 multiplied by the same 21.51, which is the same weighted average. Or another way, you can just get the beginning balance plus the purchases. You get the cost of goods sold. You subtract the end inventory that we just calculated to get the cost of goods sold, which is 27,972. So if you look here, it's the same concept. We have the 3 purchases that we made. We have the goods available for sale. The inventory and the cost of goods sold are only based on the 21.51. So 800 units multiplied by 21.51. You can also do the same thing here. 1,300 units multiplied by 21.51 should give you the exact same value. But what they did is that they got the available for sale, or the goods available for sale, or the cost of goods available for sale. They subtracted the ending inventory to get the cost of goods sold, which is the same thing. So let me stop here. In the next video, we're going to see a comparison between the 3 methods and how they impact cost of goods sold, gross profit, net income, and the ending inventory balance.